In 1981, the global financial system was fragile. Interest rates were volatile. Currencies were unstable. Inflation was breaking economic models. And somewhere in New York City, a former cab driver with no formal Wall Street pedigree was quietly preparing to risk money the way engineers risk bridges. Not emotionally, not impulsively, but structurally. This man would go on to build one of the most successful trading careers in history, not by predicting the future, but by designing a system that could survive being wrong. His name is Bruce Kovner, and if you misunderstand why he succeeded, you will copy the wrong things and fail. This file is not about trades. It is not about markets. It is not even about money. This is about how elites think when the outcome is uncertain and the stakes are existential. Welcome to Billionaire's Bookshelf. If you value long-form intelligence over short-term hype, subscribe now because this channel is not built for the masses. It's built for the serious. Why Kovner matters, the real problem. Most traders do not fail because they lack intelligence. They fail because they collapse psychologically before their edge has time to express itself. Markets do not reward brilliance. They reward emotional survivability. Bruce Kovner understood this early. He recognized that the market is an adversarial environment. Uncertainty is permanent, and ego is the single greatest risk factor. So instead of asking, "How do I win?" he asked, "How do I avoid being eliminated?" That question alone separates amateurs from architects. If this framework already feels different from everything you've heard about trading, good. That discomfort is the sound of learning. If you value long-form intelligence over short-term hype, subscribe now, because this channel is not built for the masses. It's built for the serious. In the modern landscape of finance, we are taught that success is the result of hyper-specialization. We envision the elite trader as a quantitative savant who has spent their entire life staring at a singular asset class. However, the story of Bruce Kovner, the visionary behind Caxton Associates, shatters this myth. At Billionaire's Bookshelf, we believe that the most resilient systems are built by polymaths, not specialists. Kovner did not arrive on Wall Street with a finance degree. He arrived with a diverse mental model shaped by political science, music, and the gritty reality of the New York City streets. The intellectual architecture. Kovner's journey began at Harvard, studying political science. While his peers were memorizing balance sheets, Kovner was studying the invisible gears of the world: power, incentives, and systemic decay. He learned macrocognition, the ability to see how a shift in one part of the global machine, like a government policy change, inevitably triggers a reaction thousands of miles away. This academic background gave him a unique perspective. Markets are not just numbers, they are the collective expression of human behavior under pressure. He understood that systems are inherently fragile, and those within them are often the last to see the coming collapse. The rhythm of risk. Kovner was also a student of music. To the untrained eye, music and trading are opposites, but to an architect of risk, they both rely on timing and silence. A great conductor knows that the space between notes is as important as the notes themselves. In the markets, Kovner applied this aesthetic patience. Most amateur traders suffer from an activity bias, feeling a constant need to buy or sell. Kovner's musical training taught him to wait for the market's pulse to reveal itself. He didn't force the rhythm, he interpreted it. The cab driver's laboratory. The final and perhaps most famous pillar of Kovner's foundation was his time driving a New York City taxi. This was no detour, it was a high-stakes laboratory for human psychology. In the driver's seat, Kovner refined 4 critical skills: sentiment analysis, observing raw human emotions, panic, greed, and urgency in their natural state. Environmental adaptation, learning that you cannot control the traffic or the weather, you can only adapt your route. Stress management, maintaining focus through hours of boredom to be ready for the minutes of chaos. Operational reality, living without a safety net, where income is tied directly to performance. Kovner's unlikely origin proved to be his greatest competitive advantage. Because he was a generalist, he could see the architecture of reality while specialists were busy analyzing a single brick. He entered the markets not to prove he was right, but to observe where the world was going. At Billionaire's bookshelf, we emphasize that your greatest asset isn't your technical skill, it's your breadth of perspective. The $3,000 Catalyst. In 1977, Bruce Kovner reached a point zero that would define his architectural approach to wealth. He didn't have a massive seed fund. He had a MasterCard with a $3,000 limit. At the time, global inflation was rampant, and Kovner's macro intelligence pointed toward a massive supply-demand imbalance in the soybean market. He took the $3,000 credit advance and went long on soybean futures. Within a short period, his thesis was validated. The trade exploded, and his $3,000 ballooned to $40,000 on paper. For a man who had been driving a taxi, this was a life-altering sum. But the market soon offered a brutal lesson. The price began to limit down, dropping the maximum allowed in a day, and Kovner watched, paralyzed, as his $40,000 evaporated to $23,000 in hours. He exited, shaken, but forever changed. The philosophy of inversion. Risk first. Most investors begin with a dream. How much can I make if I'm right? Kovner realized this question is a psychological trap. It triggers activity bias and emotional attachment. He flipped the script, adopting a philosophy of inversion. Before placing a trade, he asked the only question that matters for survival. Where am I wrong, and how much will it cost me? This is the architecture of risk. By defining the exit point before the entry, Kovner removed hope from the equation. In the Billionaire's bookshelf framework, hope is a toxic asset. Once you are hoping for a turnaround, you have lost your agency. Kovner's first trade taught him that the market can stay irrational longer than you can stay solvent, unless you have an automatic, pre-calculated point of exit. Loss pre-acceptance, the stoic edge. The psychological breakthrough Kovner achieved is what we call loss pre-acceptance. Most people view a loss as a failure of intelligence. Kovner began to view a loss as a business expense. Just as a restaurant owner doesn't mourn the cost of raw ingredients, Kovner didn't mourn the cost of a failed trade. By pre-accepting the loss at the moment of entry, he achieved a state of emotional neutrality. This allowed him to execute his plan without the interference of ego. He understood that the goal isn't to be right 100% of the time. The goal is to ensure that when you are wrong, it doesn't end your career. The invalidation point. Kovner developed a specific technical requirement, the invalidation point. This wasn't just a dollar amount, it was a level on a chart where his story about the market was proven false. If his thesis was that soybeans were rising due to a drought, but the price dropped below a critical support level, the market was telling him the story was dead. Amateurs create zombie stories. They keep believing in their thesis, even as the price destroys their account. Kovner's inversion principle meant that the moment the price hit the invalidation point, he was out. Conclusion: engineering over gambling. Chapter 2 of Kovner's life is about the shift from gambling to engineering. A gambler hopes for a green light. An engineer builds the brakes.
Kovner realized that the size of your win is often dictated by the market, but the size of your loss is dictated entirely by you. By inverting the problem, he built a system resilient to his own human flaws.
The Master and the Apprentice. Success in the upper echelons of finance is rarely a solitary achievement. It is a lineage. For Bruce Kovner, the bridge between driving a taxi and managing billions was a man named Michael Marcus. Marcus was a legendary trader at Commodities Corporation and a disciple of the great Ed Sikota. When Kovner met Marcus, he didn't just meet a boss. He met a mentor who had already survived the lineage of scars. Marcus had blown up his account multiple times before finding his stride. He understood that intelligence is a commodity, but discipline is a rarity. At Billionaire's bookshelf, we recognize that mentorship is not about learning a secret formula. It is about absorbing the scars of someone who survived the battles you have yet to fight. The myth of the smart trade. The most dangerous thing a new trader can have is a high IQ without a system. Marcus taught Kovner that the market does not give out prizes for being the smartest person in the room. In fact, being too smart is often a liability. Highly intelligent people often struggle to admit they are wrong, leading them to hold losing positions until their capital is decimated. Marcus instilled a brutal mantra in Kovner. You don't get paid for being right, you get paid for staying alive. This shifted Kovner's focus from intellectual validation to mechanical execution. Under Marcus's tutelage, Kovner learned that a trade is not a reflection of your worth as a human being. It is simply a data point in a much larger probability set. Marcus's greatest gift to Kovner was the gift of restraint. In a world of infinite charts and 24-hour news cycles, the temptation to overtrade is overwhelming. Marcus showed Kovner that the best traders are often the ones who do the least. They wait for the fat pitch, the moment where the macroeconomic story, the technical chart, and the market sentiment all align perfectly. This lineage of scars taught Kovner that mastery is a process of subtraction. You subtract your ego, you subtract your need for excitement, and you subtract your desire to be a hero. What remains is a cold, calculated approach to risk. Marcus had learned through failure that the market is a machine designed to transfer money from the active to the patient. By observing Marcus, Kovner was able to bypass the blown account phase that destroys 90% of traders. Kovner realized that great traders are not innovators, they are refiners. They take proven principles of risk and apply them with a level of discipline that others find boring. Marcus didn't teach Kovner a new way to see the stars. He taught him how to keep the telescope steady. This chapter of Kovner's life highlights a core Billionaire's bookshelf principle. The holy grail of trading isn't a mathematical equation. It's the ability to follow a boring plan in a chaotic environment. Marcus provided the blueprint, but it was Kovner's job to build the structure. If you want to master the systems that build empires, don't just watch, subscribe. Join the serious thinkers on the Billionaire's Bookshelf YouTube channel, where we deconstruct the elite minds of history to build your future. In the world of retail trading, risk is often reduced to a mathematical variable. Amateurs look at volatility, value at risk, or drawdown percentages. They treat risk as a static number on a spreadsheet. But Bruce Kovner viewed risk through a much more sophisticated lens. To him, risk was not a calculation, it was a structural state. Kovner understood that the true danger in the market isn't a price drop, it is the loss of agency. At Billionaire's bookshelf, we define the death zone as that moment when a trader is no longer making decisions based on logic, but is being forced to act by their emotions or their margin clerk. Once you lose the ability to choose your next move, you have ceased to be an architect and have become a victim. Risk as emotional capacity. Kovner's most profound insight was that risk is tied directly to human psychology. He recognized that every individual has a carrying capacity for stress. If you put on a position that is too large, your brain physically shifts from the prefrontal cortex, logic, to the amygdala, survival or fear. When you are in a state of fear, you cannot see the architecture of reality. You see ghosts in the charts. You exit good trades too early out of panic, and you hold bad trades too long out of desperation. Kovner designed his system to ensure he never reached his psychological breaking point. He didn't just manage his capital, he managed his internal state. He sized his trades so that being wrong was, quite frankly, boring. The automatic exit. To maintain this agency, Kovner removed the burden of decision-making during times of crisis. He treated risk as an architectural fuse. In a house, a circuit breaker doesn't ask the homeowner for permission before it trips. It shuts down automatically when the current becomes dangerous to the structure. Kovner's stop-losses functioned exactly like those circuit breakers. They were predefined, non-negotiable, and automatic. By the time a trade started moving against him, the decision to exit had already been made weeks prior. This is what we call algorithmic discipline. It is the process of using your high IQ self during the planning phase to protect your emotional self during the execution phase. The three pillars of Kovner's risk architecture. Under the Billionaire's bookshelf model, Kovner's risk architecture rests on three pillars. Technical invalidation, the price point where the story is proven wrong. Financial invalidation, the dollar amount that if lost would damage the fund's compounding curve. Psychological invalidation, the level of heat that would cause the trader to lose their cool. Risk management is the art of finding the tightest of these three constraints and honoring it above all else. Kovner knew that if he protected the structure, the profits would eventually take care of themselves. Conclusion: architecture over willpower. Most traders believe they can white-knuckle their way through a crisis. They rely on willpower. Kovner knew that willpower is a finite resource that fails exactly when you need it most. He replaced willpower with architecture. He didn't try to be tougher than the market. He simply built a better cage for the volatility. Don't just watch history happen. Learn to engineer it. For deep dives into the systems of the world's most resilient minds, subscribe to the Billionaire's Bookshelf YouTube channel. We don't just give you the what, we give you the how. In the vocabulary of the average trader, a stop-loss is a safety net, a necessary evil used to prevent total catastrophe. But for Bruce Kovner, the stop-loss was something far more profound. It was a philosophical declaration of truth. At Billionaire's Bookshelf, we teach that every trade is essentially a hypothesis. I believe X will happen because of Y. The stop-loss is the point where that hypothesis is proven false.
Kovner didn't view hitting a stop as a loss. He viewed it as receiving a clear signal from the universe that his current map of reality did not match the actual terrain. By hitting the stop, the market was providing him with the most valuable commodity in trading, the truth. The invalidation level. Kovner's genius lay in where he placed these stops. He didn't pick a random percentage or a round dollar amount. He looked for the invalidation level. This is a technical point on a chart where, if reached, the reason for being in the trade no longer exists. If Kovner bought a currency because he believed a central bank was supporting it, he would place his stop just below the level where that support would logically fail. If the price hit that stop, it meant his thesis was wrong. There was no room for maybe, no room for letting it breathe, and certainly no room for hoping it comes back. To Kovner, staying in a trade past the invalidation point wasn't just bad trading, it was a lie. Detaching ego from outcome. The reason most traders struggle with stops is ego. To hit a stop is to admit you were wrong, and for the highly intelligent, being wrong feels like a personal failure. Kovner avoided this trap by separating his identity from his positions. He understood that he was an architect, not a prophet. An architect designs a bridge to withstand a certain amount of wind. If the wind exceeds that limit and the bridge sways, the architect doesn't take it personally. They simply analyze the data and adjust the design. By treating stops as statements of truth, Kovner removed the emotional sting of being wrong. He transformed a psychological crisis into a routine technical adjustment. The mental capital reservoir. Beyond protecting financial capital, Kovner's strict adherence to stops protected his mental capital. Every open losing position is a drain on a trader's cognitive energy. It takes bandwidth to worry, to rationalize, and to monitor a failing trade. By exiting immediately when a statement of truth was issued, Kovner kept his mind clear. He didn't carry the ghosts of old trades into new opportunities. This allowed him to remain fluid and objective while his competitors were still bogged down in the emotional wreckage of their previous mistakes. At Billionaire's bookshelf, we maintain that a clear mind is the most expensive tool you own, protected with non-negotiable stops. Conclusion: honesty as a strategy. Chapter 5 of Kovner's methodology teaches us that the market is a truth machine. It doesn't care about your pedigree, your brilliant analysis, or your need to be right. It only cares about price. Kovner's success was built on his willingness to listen to the market's truth, even when it hurt. He built his empire on a foundation of radical honesty. The market tells the truth. Are you listening? Learn how to decode the language of global markets and build your own statement of truth. Subscribe to the Billionaire's Bookshelf YouTube channel to join a community of thinkers who value reality over ego.
In the circles of elite finance, there is a saying, "Show me your position size and I will show you your character." While most amateur traders obsess over what to buy, Bruce Kovner focused on how much to buy. At Billionaire's Bookshelf, we view position sizing not as a mathematical exercise, but as the ultimate test of a trader's internal architecture. Kovner understood a fundamental psychological law: size magnifies emotion. If you trade a position that is too large for your account or your temperament, you lose the ability to think rationally. Your character begins to degrade. You become greedy when the trade goes your way and terrified when it goes against you. By keeping his position sizes small relative to his total capital, Kovner ensured that his character remained steady regardless of market volatility. The math of staying boring. Kovner's goal was to make trading boring.
To the outsider, billions of dollars in play sounds like high-stakes drama. To Kovner, it was a series of small, calculated risks that individually meant very little. He famously stated that he tried to risk less than 1% of his total equity on any single idea. Why 1%? Because at 1%, a catastrophic loss is just a flesh wound. It allows you to be wrong 20 times in a row and still have 80% of your capital intact. This is the compounding of survival. By sizing his trades so that no single failure could cripple him, Kovner removed the fear of ruin from his mind. When fear is removed, the prefrontal cortex can function at 100% capacity, allowing for the kind of macro-cognition we discuss here at Billionaire's bookshelf. The corruption of judgment. When a trader over-leverages, they are essentially making a bet on their own ego. They are saying, "I am so certain of this outcome that I am willing to risk my survival on it." In Kovner's view, this was the height of arrogance. The market is an adversarial environment filled with black swans and unexpected shocks. Kovner observed that as position size increases, judgment decreases. A large position forces you to marry the trade. You start ignoring contrary evidence because the cost of being wrong is too high to contemplate. You become a zombie trader, trapped by your own size. Kovner's character was defined by his humility. He sized his trades as if he expected to be wrong, which ironically gave him the emotional freedom to stay in his winning trades much longer than the average person. The architecture of the curve. Position sizing is also about managing the equity curve. If your returns look like a roller coaster, massive peaks followed by terrifying valleys, you will eventually burn out. Kovner wanted a steady, upward-sloping line. He knew that investors and his own peace of mind valued consistency over sporadic brilliance. By using disciplined position sizing, he smoothed out the volatility of his own life. He didn't want the highs of a massive win because he knew they were usually followed by the lows of a massive ego-driven loss. He optimized for longevity. At Billionaire's bookshelf, we teach that the person who can stay in the game the longest wins by default. Conclusion: size for the long game. Chapter 6 of the Kovner file reminds us that your edge is useless if you don't have the character to execute it. Position sizing is the tool you use to protect your character from your emotions. Kovner didn't become a billionaire by being a big swinger. He became a billionaire by being a disciplined architect who knew exactly how much weight his structure could carry before it buckled. Is your ego bigger than your account? Learn how to size your life and your investments for maximum resilience. Subscribe to the Billionaire's Bookshelf YouTube channel and start building a foundation that can withstand any storm.
In a world that equates activity with productivity, Bruce Kovner's greatest strength was his ability to do absolutely nothing. Most traders feel a psychological itch to be in the market at all times, fearing that a day without a trade is a day of lost opportunity. At Billionaire's Bookshelf, we identify this as the action bias, a survival instinct that is lethal in the world of high finance. Kovner operated like a high-altitude predator. He understood that 90% of market movements are noise, random fluctuations that have no structural meaning. To trade the noise is to bleed capital through 1,000 small cuts. Instead, Kovner waited for the rare moments of structural displacement, where the macroeconomic reality and the market price were so far apart that a massive correction was inevitable. He didn't chase the market. He waited for the market to come to him. The search for asymmetry. The core of Kovner's waiting was the search for asymmetry. An asymmetrical trade is one where the potential downside is strictly limited, while the potential upside is vast. This is the billionaire's math, risking $1 to make $10. Most people trade with a 1-to-1 ratio, risking $1 to make $1. This requires you to be right more than 50% of the time just to break even after fees. Kovner, by waiting for asymmetry, could be wrong 70% of the time and still build a fortune. He wasn't looking for good trades, he was looking for unfair trades. He waited for the moments when the market was so mispriced that the risk of entry was negligible compared to the reward of being right. Urgency as a signal of insecurity. Kovner famously observed that whenever he felt a sense of urgency to get into a trade, it was usually a signal that he was acting on emotion rather than analysis. Urgency is the language of the ego. It is the fear of missing out, or FOMO, masquerading as conviction. At Billionaire's bookshelf, we teach that if a trade is truly a macro opportunity, it will not disappear in 5 minutes. If you have to rush, you are likely gambling. Kovner's stillness allowed him to remain objective. He would watch a setup develop for weeks or even months, refining his entry points and waiting for the exact moment of technical invalidation to be at its tightest. This patience turned time into his greatest ally rather than his enemy. The discipline of the no. Being a billionaire architect of risk is less about saying yes to the right things and more about saying no to almost everything. Kovner's filter was incredibly high. He would pass on dozens of decent setups because they didn't meet his criteria for asymmetry or structural clarity. This discipline of the no is what separates the elite from the masses. The average trader wants to be busy. The elite trader wants to be effective. Kovner knew that every yes to a mediocre trade was a no to the mental and financial capital required for a great one. He saved his firepower for the few times a year when the stars aligned. Conclusion: waiting as a competitive advantage. Chapter 7 of the Kovner File teaches us that in the markets, the fast usually lose to the patient. Kovner's $8.6 billion fortune was built on no high-frequency activity. It was built on a few massive asymmetrical wins that he had the patience to wait for and the courage to hold. He mastered the art of the strategic pause. Are you trading because there's an opportunity or because you're bored? Stop gambling and start waiting for the unfair advantage. Subscribe to the Billionaire's Bookshelf YouTube channel to learn the art of predatory patience and high asymmetry thinking.
In an era where every move is broadcasted on social media and financial news, Bruce Kovner's greatest tactical advantage was his silence. He understood a principle we hold dear at Billionaire's Bookshelf. Attention is a performance tax. The more people watch you, the more your ego becomes attached to being right, and the harder it becomes to change your mind when the facts change. Kovner operated in the shadows. He didn't seek the limelight, didn't do victory lap interviews, and didn't brag about his wins. By maintaining a low profile, he protected his decision-making process from the noise of public opinion. When you are quiet, you can be wrong in private, exit a trade, and move on without the embarrassment of a public reversal. This psychological freedom is the fuel for long-term compounding. The mathematics of longevity. Compounding is often called the eighth wonder of the world, but most people misunderstand its fuel. Compounding isn't driven by high returns, it is driven by time. To compound wealth, you must first survive. Kovner's entire architecture, his small position sizes, his strict stops, and his predatory patience was designed for one thing: longevity. He didn't aim for 100% returns in a single year because he knew that the risks required to achieve that would eventually lead to a 100% loss. Instead, he aimed for consistent, positive returns over decades. At Billionaire's bookshelf, we visualize this as a compounding curve. In the early years, the growth looks slow and unexciting, but because Kovner never had a catastrophic year that reset his progress to zero, the curve eventually turned vertical. Optionality, the ultimate wealth. As Kovner's capital grew through quiet compounding, he gained the most valuable asset in the world: optionality. Wealth isn't about buying things, it's about the ability to wait for the perfect opportunity without desperation. Because he had compounded his capital so relentlessly, he never needed to take a bad trade. This created a positive feedback loop. His success gave him the capital to wait, and his waiting gave him the success to grow his capital. While other traders were forced to take high-risk bets to catch up or satisfy investors, Kovner remained in a position of total strength. He had built a fortress of capital that allowed him to dictate the terms of his engagement with the world. The legacy of the architect. Kovner eventually retired from Caxton Associates as a billionaire many times over. He didn't burn out, and he didn't blow up. He simply completed the structure he started building decades ago. His legacy is not a specific trade, but a blueprint for how to interact with an uncertain world. He proved that you don't need to be loud to be powerful, and you don't need to be aggressive to be successful. You just need to be relentless and resilient. Conclusion: the silent empire. Chapter 8 of the Kovner file concludes with a simple truth. The loudest voices in the room are rarely the ones with the most capital. True wealth is built quietly through the disciplined application of a resilient system over a long period. At Billionaire's bookshelf, we don't teach you how to get rich quick. We teach you how to build a system that makes wealth inevitable. The most powerful moves are made in silence. Stop chasing the hype and start building your own silent empire. Subscribe to the Billionaire's Bookshelf YouTube channel and learn the quiet art of long-term compounding.
As we close the file on Bruce Kovner, it is vital to realize that this study was never actually about trading. At Billionaire's Bookshelf, we deconstruct these titans not to teach you how to click a buy button, but to show you how to build a mind that can withstand the weight of the world. Kovner's $8.6 billion fortune is simply the byproduct of a superior internal architecture. The markets, much like life, are a chaotic, adversarial environment. Most people enter this arena with hope as their primary strategy. They hope the economy recovers. They hope their boss notices them. They hope their investments go up. But hope is not a pillar, it is a vapor. Kovner replaced hope with a structural design that turned uncertainty into an advantage. The 3 pillars of the Kovner mind. To apply the lessons of this file, you must adopt the 3 core tenets of Kovner's resilient architecture. Detach ego from outcome.
You are not your trades. Whether you are launching a business or making an investment, being wrong is simply data. Use it to refine your map of reality. Define the exit before the entry. Resilience is knowing exactly where your invalidation point lies. In every venture, ask, at what point is this story no longer true? When you hit that point, leave without hesitation. Let time do the heavy lifting. The quiet compounding we discussed is only possible if you survive. Stop looking for the grand slam and start looking for the unfair asymmetry. Risk a little to gain a lot, and stay in the game long enough for the math to work. The architect's mandate. Bruce Kovner proved that a former cab driver with a diverse, polymathic mind could outmaneuver the most sophisticated institutions on Earth. He didn't do it by being louder or faster. He did it by being more structurally sound. He built a system that allowed him to be wrong frequently while still becoming one of the wealthiest men in history. This is the ultimate goal of the Billionaire's bookshelf. We are not here to gamble on the future. We are here to engineer a version of ourselves that can thrive regardless of what the future holds. The lessons of Bruce Kovner are just the beginning. If you are ready to stop reacting to the world and start designing your place within it, you belong with us. Subscribe to the Billionaire's Bookshelf YouTube channel. We provide the blueprints, the case studies, and the hard-earned intelligence required to build a life of absolute resilience. Join the serious thinkers today.